What if I told you that you can learn a set of investing rules that will help you beat the market consistently, even with only a small amount of money to invest? You may be avoiding investing because you think it's something that's reserved for only the rich. But actually, this couldn't be further from the truth. The way to get wealthy is to invest. And if you want to build wealth and get rich from the stock market, Peter Lynch is the man to study. Lynch is one of the most successful and well-known investors of all time. And for 13 years, he managed the Magellan Fund, earning an annualized return of 29.2%, which was more than twice what the S&P 500 earned during that time. His strategies are quite simple and accessible to everyone, demonstrating that you don't need an MBA from Harvard to make serious money from investing. And fortunately for us, Mr. Lynch has given us a backdoor insight into the stock market through his various books and interviews. In this video, we will provide Lynch's 5 best investment strategies, which, once put to use, can put you ahead of even Wall Street professionals, even if you only have a small amount of money to invest. Make sure you watch the full video, as at the end, we'll be showing you the common pitfalls that all investors must avoid. So, let's get started. Strategy 1. Know what you own and why you own it. This famous mantra of Peter Lynch is the single most important lesson for small-time investors, and is something shared by other big investors like Warren Buffett, who also emphasizes the importance of understanding the companies in which you invest and having a clear rationale for holding them in your portfolio. The first time I heard this mantra, it sounded obvious to me. Of course, someone can't own a stock without knowing why they bought it. Even a 10-year-old can understand that. So, to put it to the test, I called up my 10-year-old nephew and showed him my portfolio. The little guy must have barely understood what was going on, but when I tried to explain to him why I bought the stocks of a particular company, I very quickly ran out of ideas. The best reasons I could come up with were market trends, advice from others, and price. I soon realized that Lynch was right, and my portfolio was nothing but a gambling deck. I had no idea why I owned anything or what the intricate details of the companies I'd invested in were. If you truly understand why you are investing in a company, you should not only be able to explain it simply to a 10-year-old, you should also be able to talk for hours about that stock if ever you needed to. Understanding what you own involves having a deep knowledge of the businesses behind the stocks you invest in. This includes understanding the company's products or services, its competitive position within its industry, its financial health, management team, growth prospects, and potential risks. By thoroughly researching and understanding the companies you invest in, you can make more informed decisions and better assess their long-term investment potential. Equally important is knowing why you own a particular stock. This means having a clear reason for holding the stock in your portfolio. Your reasoning should be based on a combination of factors, including the company's growth prospects, valuation, dividend potential, industry trends, and your own investment goals and risk tolerance. By articulating why you own a stock, you can better evaluate whether it still aligns with your investment objectives as market conditions change. If you are not clear on what the company does or why you own its stock, then the only thing you have to base decisions on is the stock price, meaning that you will be easily shaken by the ups and downs of the market. The key point is, you invest in good businesses, not good stocks. When the price falls, what is the chance you hold onto the stock if you can't answer 2 basic questions about the company? Let's face it, if you don't understand the fundamentals of a company, you are more likely to panic and sell when its stock price is falling. Lynch's advice underscores the importance of taking a thoughtful and disciplined approach to investing. By knowing what you own and why you own it, you can avoid making impulsive investment decisions based on market hype or speculation. Instead, you can focus on building a well-rounded portfolio of companies that you understand and believe in, with the potential to generate long-term returns. This strategy is just as essential if you choose to own funds, such as mutual, index, or ETFs instead. The easiest way to verify the viability of anything, including a business or stocks, is to explain your understanding of it to someone else. If you cannot explain why you are investing in a business to even a 10-year-old, it is best you take 2 and do some more research. Before we move on to Strategy 2, please don't forget to click the subscribe button if you want more weekly updates on how to build massive wealth, even in market downturns. Okay, moving on. Strategy 2. Look for long-term investments. Only focusing on short-term price movements is the fast way to get burnt in the stock market. Stock prices fluctuate all the time for various reasons that are both inside and outside a company's control. Take Meta, for example. As you can see from this chart, it went through a rough patch in late 2022, causing its stock price to drop by 72% from the beginning of the year. An insane drop. Many investors panicked during that period and sold for a massive loss. But long-term investors that had a strong understanding of the business knew this was just a short-term blip. And sure enough, the stock price rallied in 2023, finishing the year up 289% from its November 2022 low. Lynch believes that investing with a long-term mindset allows investors to capitalize on the power of compounding returns. Compounding occurs when investment returns are reinvested and earn additional returns over time. Let's use the example of John to explain this concept. John is a savvy 20-year-old who invests $200 every month for the next 40 years. Assuming an 8% annual rate of return, when John reaches the age of 60, he will have invested $96,000. But his investment pot will be worth a massive $645,000, meaning John's money has grown by $549,000, all thanks to the power of compounding. Now, had John waited until he was 40 to start investing, then at age 60, his investment would only have been worth $114,000. It's time in the market that gets you rich. By holding on to investments for the long term, investors give compounding more time to work its magic, potentially magnifying their investment gains over the years. Lynch also emphasizes the importance of giving companies time to realize their full growth potential. Many successful companies undergo periods of volatility and short-term fluctuations in their stock prices. By focusing on the long term, investors can look past these short-term market movements and hold on to quality companies that have strong growth prospects and the potential to create significant value over time. Lynch believes that long-term investing reduces the impact of market timing and short-term speculation on investment outcomes. Trying to time the market and make short-term trades based on market fluctuations is notoriously difficult and often leads to subpar investment results. By taking a long-term approach, investors can avoid the pitfalls of market timing and focus on the fundamentals of the companies they invest in. Strategy 3. Keep an eye out for growth opportunities. Peter Lynch is known for his admiration of growth stocks. So, when assessing potential investments, opt for firms with high growth rates, sustainable competitive advantages, and a long history of innovation. Smaller companies can typically offer such opportunities, as smaller companies have a lot of room to grow, and they can be nimbler and more innovative compared to larger, more established companies. But this is not the only thing that makes smaller companies attractive. Smaller companies are often overlooked by investors, but often have more growth potential than the already established mega companies in the industry with little room to grow, presenting opportunities for substantial returns on investment. While many people may not know this secret, it makes total sense when you think about it. For instance, it is easier for a company to go from a market capitalization of $10 billion to $100 billion than for a company to grow from $100 billion to $1 trillion. Lynch believes that small companies often present unique opportunities for investors to find undervalued stocks before they become widely recognized by the market. Indeed, he believes that small companies are often overlooked by institutional investors, providing individual investors with an advantage. This is because institutional investors, such as mutual funds and pension funds, tend to focus on larger, more liquid stocks that meet their investment criteria. As a result, small companies may be less efficiently priced, presenting opportunities for astute investors to uncover hidden gems. However, Lynch has also cautioned that investing in small companies comes with higher risks compared to investing in larger, more established companies. Small companies may have limited financial resources, higher volatility, and a greater susceptibility to economic downturns or industry-specific challenges. Therefore, he advises investors to conduct thorough research and due diligence before investing in small companies and to carefully assess the risks associated with these investments. Strategy 4. Focus on the micro. Instead of worrying about the wider economic climate, known as macroeconomics, Peter Lynch recommends you study individuals and businesses, otherwise known as microeconomics. In other words, your focus should be on the trees instead of the forest. Lynch recommends that investors focus on microeconomics because he believes that understanding individual companies and their specific business fundamentals is more important for successful investing than trying to predict broader economic trends. Microeconomics deals with the behavior of individual firms, industries, and markets, focusing on factors such as supply and demand, pricing dynamics, competitive forces, and consumer behavior. Lynch believes that by thoroughly researching and analyzing the microeconomic factors that affect individual companies, investors can gain insights into their growth potential, competitive advantages, and financial health. This bottom-up approach allows investors to identify undervalued or overlooked stocks with strong fundamentals and growth prospects. In contrast, macroeconomics focuses on the overall economy, including factors such as GDP growth, inflation, interest rates, and government policies. Lynch once said, "If you spend 13 minutes a year on economics, you've wasted 10 minutes." He argues that trying to predict macroeconomic trends is a fool's errand, as there are too many variables to think about, and even professionals get it wrong more often than not. While macroeconomic trends can influence the performance of the stock market and individual companies to some extent, Lynch argues that these factors are often unpredictable and subject to interpretation. Attempting to forecast macroeconomic trends and their impact on the stock market can be challenging and may lead to suboptimal investment decisions. Instead, he suggests that you focus on the performance of individual companies. So, you should rather spend time researching a particular firm, its financial statements, and its industry trends to see if there are investment opportunities in the industry. When you focus on the individual firms within an industry, you can identify potential opportunities that may not be seen in the broader economy. Lynch's perspective on macroeconomics reminds us that we should focus on what we know and what we can control. Indeed, even if you could successfully predict how the macroeconomic climate will change over time, predicting how the stock market will react to those changes in the economy is a whole other game. Just look at the global pandemic in 2020. Many economists and investors correctly predicted how difficult the year was going to be for the economy. GDP contracted and unemployment skyrocketed from just over 3% to, at one point, almost 15%. However, if you sold your stocks based on the economic outlook of the country alone, you would have lost a lot of money because the S&P 500 grew by over 18% that year. So, try to keep your focus on the micro elements of your investment and let the economists worry about the wider economy. If you can do that, you are already ahead of most people in the stock market. Strategy 5. Know which stocks to avoid. Arguably, one of the most important skills as an investor is to understand the types of stocks to avoid at all costs. Peter Lynch points out that knowing these simple tips will save the average investor a huge amount of time, effort, and, most importantly, money over their investment careers. In his view, all investors should avoid the following. Number 1. The hottest stock in the hottest industry. Lynch's advice against chasing the hottest stock in the hottest industry is a timeless lesson. These are typically the types of stock you hear about on online forums, social media apps, and in the workplace. Lynch cautions against such stocks because the hype surrounding these stocks often leads to overvaluation, where their prices soar beyond their intrinsic value. Consequently, investors may end up paying more than what the company is truly worth. The feverish excitement surrounding these stocks can also create unrealistic expectations. Even if the company performs well, it might not meet the lofty forecasts set by investors, resulting in disappointment and potential losses. Additionally, hot industries attract fierce competition and rapid innovation, making it challenging for any single company to maintain its dominance. Investing in the hottest stock means exposing oneself to the risk of being outpaced by newer, more innovative competitors. Industries go through cycles of growth and decline, meaning today's hot sector may cool off tomorrow. Placing all of your bets on the hottest stock in a trendy industry could spell trouble if the sector experiences a downturn or falls out of favor. Instead, Lynch's philosophy encourages investors to focus on understanding the companies they invest in rather than blindly following market hype. Number 2. Stocks of companies going through diversification. Peter Lynch advises against investing in stocks of companies going through diversification primarily because it introduces uncertainty and complexity into the investment thesis. When a company diversifies into new industries or ventures, it often strays from its core competencies and may spread its resources too thin. This can lead to inefficiencies, increased costs, and a lack of focus on what made the company successful in the first place. Additionally, diversification efforts can distract management from properly managing the existing core business, potentially leading to a decline in performance. Shareholders may also become skeptical of management's ability to execute the diversification strategy successfully, which can erode confidence and lead to a decrease in stock price. The success of diversification efforts is uncertain and may not always translate into increased shareholder value. Companies often overestimate their ability to enter new markets or industries successfully, leading to disappointing results and a negative impact on stock performance. Overall, Lynch believes that investors are better off investing in companies that stick to their core competencies, focus on what they do best, and demonstrate a track record of consistent performance. Diversification, if not carefully executed, can introduce unnecessary risk and uncertainty into an investment portfolio. Number 3. Whisper stocks. Whisper stocks are typically characterized by intense speculation and hype surrounding a particular company or industry, often fueled by rumors or unverified information. Peter Lynch advises against investing in whisper stocks because they often lack fundamental substance and are driven more by rumors, speculation, or insider information rather than solid business fundamentals. Investing in whisper stocks carries significant risks, as the information driving the stock price may not be reliable or accurate. Acting on rumors or insider tips can lead to making investment decisions based on incomplete or misleading information, which increases the likelihood of losses. Whisper stocks also tend to be volatile and susceptible to sudden price swings based on unsubstantiated news or market sentiment. This volatility can make it difficult for investors to accurately assess the true value of the stock and make informed decisions. Lynch believes that by conducting thorough research, investors can make more informed investment decisions and avoid the pitfalls associated with speculative whisper stocks. If you want to learn more about which assets to invest in this year, click on over to this video where I show you just that. Thanks for watching, and until next time, keep building your wealthy life.